some economists fear that the Fed, humbled by staying too long and saying transitory, is now staying too long in terms of raising, and we don't know yet. We haven't had an earnings season. We don't know how it's really affecting things. They may break something. We may already be in a sharp slowdown. Maybe they stay at this party too long, the tightening party. You don't think so?
So there's two elements to this. Can they stop? Can they pivot? No, they cannot. They cannot because the data doesn't give them enough of a green light. But importantly, their credibility has been hit really hard. Will they end up overdoing it? Most likely, yes. So they've gotten themselves into this hole, and unfortunately, they don't know how to get out of this hole. There's no ladder out of this hole. People have to realize there's no ladder out of this hole.
Should we say, gee, you guys, your credibility was damaged. Now you've got to regain your credibility. Is that good for us and for the country that they have credibility, or are we paying for their mistake with a recession that we really, I don't feel like paying for their mistake with a recession just so they can regain credibility.
Well, first of all, you have no choice but to pay for their mistakes. And that's one of the tragedies of the situation. Yes, we're all going to pay for their mistakes. And some people are already paying. There was another concern that you brought up, Becky, this morning with Roger, which is it's not just about inflation, recession. It's also about financial stability. That's the third leg of this thing. So yes, Joe, I don't know how we can avoid paying for this mistake because they have been late. They mischaracterized inflation as transitory. When they finally recognized their mistake, they didn't act. Remember, in the middle of March, when we printed the February inflation print over 7%, they were still injecting liquidity into this economy. That's last March.
Mohamed, wait a second. When you say the third part of the equation, the financial stability, do you think there is the risk that things will be broken in the markets if they raise another 75 basis points?
This is the most front-loaded interest rate hiking cycle we've had for decades. We're coming from zero interest rates. The whole system got conditioned to believe that zero interest rates was forever, that injections of liquidity were predictable, and now we're adjusting. The UK has given us a warning sign.
But there are people in the market who still haven't taken the Fed seriously, so they have not gotten themselves to a place where they're not going to have massive issues if the Fed doesn't slow down?
So we have, first of all, this is the non-banks, not the banks. So that's the good news, because the banks are in the middle of the payments and settlement system. The non-banks are not. So that's good news. Yes, there are certain. You can start with the zombie companies who are finding it much harder to refinance. And if they can get refinancing, the cost of this refinancing makes their numbers look completely different. Mm-hmm. Then you can go to various investors who over-levered. That's going to be an issue. So, yeah, we have to keep an eye on the third element, which is financial stability. It's not just about inflation and growth. It's also about financial stability.
That's almost an argument for slowing down and maybe only going 50 basis points, if that, at the next meeting, just because it's not going to help your credibility. If you're doing this for your credibility, things break and you have to instantaneously backtrack like the Bank of England
I'm
did.
at 50.
Okay, so this
I'm at 50. They don't give a damn, but I'm at 50.
Well, you think they'll do 50?
No, I want them to do. I think they should do 50.
They can't. They can't.
Well, I think
they absolutely can't. If they do 50, then we will be at this table talking about stagflation.
So we have some people on saying, who was it, Mr. Wonderful? There are companies that they're not even noticing any slowdown at all right now. And then I don't know if I think that employment reports are lagging, so that could happen really quickly. We could see some issues there, or maybe not. But is the economy really, really still strong? And can we use 3.5% as an actual real employment number right now?
So I think the labor market is strong with one really important qualification, labor force participation. And that came down again. And remember, there's two answers to our issues: more labor force participation and more productivity. That is what we need, and that solves so many issues in the economy today. And the labor report was strong across the board except for labor force participation.
Do you think, Mr. New Normal, do you think because you sort of coined that term, do you think there's a new normal in terms of how we do business and how we work in this country in terms of hybrid, remote?
So I think of us as, and you're not going to like this, Joe, but as on a bumpy journey to a new destination. So what does the new destination look like?
Yeah.
First, tighter financial conditions. No more zero interest rates, no more injections of liquidity. That's gone.
People at home in their basement on Zoom calls?
No, hold on. The second element is a different type of globalization. And the third element is we're going to struggle at the global economy to provide high growth. We don't have potent growth models anymore. The US is in a much better situation than other countries, but the globe as a whole has issues.